I'll record it and we'll put it out. We can all share it. So anyway, hey guys, thanks for coming on. Don killed it last week, dude. I'm going to put that thing out. That was, it's an eye opener. I think everybody will agree that we all need to learn how to preserve what we earn. And that's something we were just talking about, you know, right before I hit record was with Bobby. One thing that we have that's different than a lot of other people in professionals is we don't have a job set up that tells us to do that, right? That shares with us, we need to put this money back, but we also have the ability to make a lot of money. So you close a couple of $1 million in a month, there's money there. We just need to do the right buckets of putting it in it. And today I want you to share with us a little bit about the retirement plans that we talked about. I want people to ask, you know, if they watch the videos, if you know, prior to this, I want them to ask any questions that they want, like Bobby was just talking about. And I just want people to see, like, if you make a $5,000 commission check, how you should take that part of it before you ever get it and do something with it. Put it to an account, have it automatically drafted out. The way people get wealthy is they don't see their money. Take it away, Don. Thanks, bro, for being here.
Yep, no problem. Thank you. And I do apologize if there's any background noise from time to time. I'm in a hotel right now. But yeah, there's lots of things to think about. Like I was just saying, one thing is you definitely want to have that solid foundation. If you've watched like the living benefit video, the little 2-minute video that explains living benefits, you want to make sure and have something like that in place. Main reason is, you know, the #1 cause of foreclosure, bankruptcy, business failure has nothing to do with death. It has to do with critical and chronic illnesses. You become disabled and you can't work and now you don't make any money. So you want to make sure you have living benefits on your life insurance, because life insurance typically, if you have traditional, is only going to pay out if you die. It doesn't do anything while you're still alive. You'll still go bankrupt. If you have living benefit life insurance, it'll pay out 90% of your life insurance while you're still alive. So you could have a heart attack, which you will probably live through now with technology. You could have cancer, which you probably will live through now. And you get 90% of your life insurance while you're alive, tax-free, never have to pay it back. You had $1 million policy, you'd get $900,000 cash if you had a quadruple bypass surgery for a heart attack. And so that goes straight into the bank. We can use that to build a pension for you right away. We could put, you know, if you were getting that kind of money, because you can get up to 1.5 million in living benefits payout while you're alive. And with that kind of money, we could put a few $100,000 away for you to live on. And then we could take the other $1 million and build a pension that'll pay you for the rest of your life. And so there's lots of ways to move that money around as it starts to come out, and it's all tax-free. And so that's a huge thing, and it'll always stay tax-free for you in the formats that we would use.
Can I ask you a question real quick about the living benefits? Yeah. So like in my program that I have, right, we've had it, what was set up in 2014 or something, I think, right?
Correct.
It has living benefits, but they've added, like, this thing is, you know, these programs get better and better and better as they go along, right? They kind of evolve to what people need. Correct. Is mine dynamic? Does it change, or does it stay the same as it was on our original annuity living benefit plan?
It stays the same as you originally got it.
Okay.
Yeah. So with yours, the only thing I don't think yours has on it is the severe burns and brain injury. Now, if you had Alzheimer's or something like that, yours would pay out. But it's the accidental piece that came in, I think, right around 2016, 2017, and you had yours a little bit before that. Again, that's also why we have people, sometimes they'll get the retirement plan and then they'll add a term next to it that can be converted into the retirement plan, because now with no medical questions at all for the next 15 to 20 years, we can convert that term into your current plan, which makes you, allows you to put more money into it. It makes it bigger. And when you do that conversion, it changes all the rules to the new rules. And so if you do that conversion, it would turn your retirement plan into the new plan that has the accidental piece on it.
And I just personally terminated my other term. Remember? Didn't we do that? Yeah.
Yeah. If you would have converted it in, it would have changed it.
Yeah. Way to go, Don. That cracked me up.
So that's one thing. The other thing is, when you're looking at the retirement plans, you got to think about the tax-free aspect of it. If you're in a taxable account that can lose money, you have to earn a lot more money. So on 401ks, IRAs, things like that, which we can set up, but you want to make sure you understand that when you retire on those policies, you have to pay tax on all the money in it because you don't pay any tax as the money's going in. And so nothing has ever been taxed. And if it grows, if you put 100,000 in and it goes to 500,000 and you start pulling money out, you owe taxes on all that money and it will all count as income. So when it's coming in, you're not going to get your full Social Security. It's going to be means tested and you're pulling too much money out. And you're going to pay more for your Medicare because it's also means tested and all that counts as income. Whereas if you start pulling money out of your pension, if we set up a pension for you, A, it's tax-free. B, it'll never lose money when the markets are crashing like they have been the last few months. And C, it does not count as income at all. You still get your full Social Security, you still get your full Medicare benefits and all that kind of stuff. And so there's a lot of reasons to have that pension in place. And then another form, like Daniel was saying, there's multiple ways you can look at it. We have secure retirement accounts that have no life insurance on them at all. Some people, want that piece as well. So maybe you have an old 401k out there. We need to do a rollover and you don't want to pay taxes right now. So we're going to roll that into what's called an FIA. If you watch the video that says, I believe it's stress-free retirement, that's the FIA video. That way we roll it over. It doesn't have any life insurance attached. So your health no longer matters for those types of policies and they never lose money as well. The issue with an FIA though, just keep in mind is it does keep the tax burden of whatever you move into it. In an FIA, if I roll a 401k to it, a 401k is completely taxable. So the FIA will be completely taxable. If you have an old Roth, we can roll that over. The Roth is tax-free. Your FIA would be completely tax-free. If you have a brokerage account, which means it's taxable on the gains, but not on the principal, you roll that in, the FIA will be taxable on the gains, but not the principal. So think of it kind of like a chameleon. It's going to keep the same tax burden that you currently have, but you will no longer ever take losses and the fees go away. So your 401k is charging you 2% a year in brokerage fees on average, and that comes out of the entire amount. And then if you roll that into an FIA, it works completely differently. The FIA charges what's called a 1% spread. A spread means they're only charging you on the gains, not on everything in your account. And so if the market went up 10%, instead of your 401k and you had 100,000 and now you got 110, and so you owe 2% of 110,000 that year to your broker, on your FIA, if it goes up 10%, they would keep 1% of the 10,000 of gain. So it's way, way cheaper to hold the money. You never take a loss again because it cannot lose money due to a market downturn. It's free for you to do. And right now, the reason why I'm down here near Florida, I'm right above the border because I have some clients in Florida that want the Georgia FIA because it's the best one in the nation right now. And so they have to come up here to sign for it. So I drove down here to help them. It has a 200% participation rate bonus. What that means is if the market does 10%, they get 20%. It doubles whatever the market's currently doing. It's completely uncapped, costs them nothing to do, and they only pay a 1% spread for that feature. So it's a no-brainer to move large lump sums of money out of the market into that FIA right now because of that 200% participation rate that you get. While you're in a 401k and IRA and things like that, you have a 100% participation rate, meaning you get 100% of whatever the market does, up or down. In the FIA, you get 200% of what the market does, up only. You cannot take a negative number. The worst you could do in that any given year is a 0 if the markets go negative. The market could tank 50%. You'd get a 0 that year. You just wouldn't.
But that doesn't have the term life insurance based on it as well, right? So
correct.
If you're trying to take care of your family, you're the breadwinner, and so
then that's the pension.
That's the big piece of it. So that's not combined in that one, right?
No. Okay. That is the secure piece for retirement plans you already have, and now you're worried because they're losing money.
Right.
So we can roll those over and protect them and make them grow better for you. But what Daniel's talking about is the pension, because the pension does come with life insurance. So it has the living benefits. It has everything in case you get sick, disabled, things like that. So there's multiple pieces. And you can have money in all types of things. Like I said, we teach people how to set up that secure side. Once they got that set up, then based on your analysis and what your goals are, we coach on a lot of other stuff, just like I'm sure Daniel's coaching you guys on real estate all the time. We do the same thing. And so it's just how much money you're trying to put in each of these asset classes. And then we help you try to make those decisions on how to move that money around.
Will you talk a little bit about being your own bank and kind of how the easiest way being, and Don used to be a licensed real estate agent too. I don't know if he still is or not, but so in order to take the money and not miss the money is my biggest thing. That's what I had to learn to do is put it away, not see it, kind of like how our stock options and things work. It goes away. You take the 5% of your commission check, it goes towards the free 10% stock, that kind of thing. You don't see it, so you don't miss it, right? So I take mine, I put it in a bucket, a checking account that's just for that. It automatically drafts every month, $1,000 out of it. But if I make, 12 grand, I'll go put it all in there, and leave it. But talk to them about the being your own bank, like if you're trying to buy a car for your kid or anything like that in the future.
Right. And so there's multiple ways to do it. You can actually use your pension like Daniel does as a bank after about 10 years. So all the pensions that we set up, they will turn into banks in the future. It gives you the ability to borrow the money right back out. You can borrow up to 90% of the money in your policy at any time, use it how you want, put the money right back in. No money physically comes out of your account. Your account continues to grow while you have this money coming out. It's called arbitrage. So what you're doing is it's called a participating loan. So let's say you've got $100,000 in your account. You can borrow up to $90,000 out of that account at any time, but no money comes out of your account. It's a participating loan, meaning the insurance company participates in what you're doing. They've got billions in their general fund. Your account had $100,000 in it. There's no risk at all to them to give you the 90,000 you want or 50,000 or whatever that is, because your account is at their office. They can get their money anytime they want. So what they do is they understand that the longer your money stays in your account, the more money they make. Because as your account's growing, they're getting fees off of your account. So they don't want money coming out of your account. So what they do is if you say, you know what, I got 100,000 in this account, I need to buy a new car. I don't want to go to Bank of America and deal with them. I'm an entrepreneur. I don't have to prove a bunch of stuff. I could pull $50,000 out of this account. 100,000 is going to stay in your account. They're going to put a lien of 50,000 against it and give you 50,000 out of their general fund. So basically you're using the insurance company's money to buy that car. Now what's happening? Instead of you paying interest to a bank, this is your personal bank. You're the banker. So you're the one that's going to be making money on your own money. So now you've borrowed money to buy a car. There's a 50,000 lien on your $100,000 account. This year, when the market goes up, say 8%, and your account's supposed to credit 8%, the 50,000 that has no lien against it is going to grow at 8% this year. The 50,000 with the lien against it is going to grow at 8% minus 3.5%. So you're still going to make 4.5% on the money you've got loaned out working for you. The way real estate investors use these banking systems is they'll usually set up a bank day one instead of putting a pension in. Well, they do pensions and banks at the same time usually. So instead of having a pension, which is like a monthly payment, and it takes time for you to really start borrowing out of it, you can set up what's called a bank. And if you want to be a hard money lender, hard money lenders use these to set these banks up. So let's say you had 100,000 cash and you knew you were going to have that kind of money coming in. You might do what's called a 5-pay, 100,000 a year for 5 years. As soon as you put because you can't put it in all at once, the IRS won't let you. You got to take time to build these banks up. So if you put 100,000 in the very first year, after 30 days, you could borrow about 85,000 right back out again. So what a lot of people that are in the real estate investment markets do is they'll throw 100,000 in this year. They're going to borrow 80,000 out to do a flip in 3 months. They're going to make money on the money they've got borrowed out. So if they're going to make 12, 15, 20% on the flip, plus they're making 4 or 5% on the money they've got loaned out to themselves. And they're using the insurance company's money, not their own. And as they put that back in, they'll bring it right back out 30 days later. buy another house to do a flip. Once they pay that one back within 90 days, they're going to keep doing it over and over. And you can do that all you want. When you're building the bank, you have access to 70 to 90% of your money in 30 days. When you're doing a pension, it will turn into a bank eventually, but it usually takes a few years before you want to touch that first bit of money as far as borrowing.
Is there a rule to it about how much you have to put into your own bank to be your bank before you can start borrowing it out? Or is it like, would you get there putting in, $100 a month? Would you ever get there? No.
You would after 10 years.
10 years. Okay.
Yeah, 10 years. Typically, if you're going to truly do a bank from the beginning, you're usually doing 20,000 or more. Most of our banking clients do anywhere from 30 to 50 to 100,000 at a pop. And they'll do what's called a 5-year bank or a 10-year bank. You choose kind of how you want to do it. If you do a 5-year bank, it's very static.
It's front loading then, is what you're saying.
Yes, very, very heavily loaded in the front. And then you have access to your money very quickly. If you do a 5-pay, the price you choose is what you're doing. 50,000 a year for 5 years. There's no changing it up or anything like that. And you're done. You can't put any more money in. It's going to start growing, but that's it. You're done. If you do a 10-pay, you can overfund. If you start at 50, you could put 70 in 1 year if you want to. You could drop it to a lower payment if you're having a hard year. It's very flexible if you're doing a 10-year, and at the end of 10 years, you can stop or you can continue putting money in. You can't do that with a 5-pay. So again, depending on your personal, what you're trying to accomplish with your bank, that's what would determine if you truly wanted to build a bank instead of just a pension plan. Because remember, the pension and the bank are both going to turn into retirement for you one day. It's just, do I need more access to this money right now while I'm growing my business? Or is this money really allocated for retirement? That's kind of how you want to look at that. And like I said, I have lots of clients that do both. They put some of their money in lump sums that they want to have access to immediately. And then they have like a regular payment they also have set up for their pension side.
So I have another question. What if you don't pay it back?
Then
when you lose the money, you borrow 30 grand and you lose it.
Yep. So when you pass away, let's say if you never pay it back, we want you to pay it back so you can borrow it again.
Right.
But if you never paid it back, let's say there was $500,000 of insurance protecting that account and you borrowed $30,000. When you passed away, your family wouldn't get $500,000. They would get $30,000 plus whatever interest is on there. So let's say it's $45,000. Well, let's keep it easy. Let's say it's $50,000 at that point after 20 years. So instead of $500,000, they'd get $450,000 because your loan would be paid back.
And then also, I know everybody's thinking this: up and down real estate market, how we all make our money, up and down. How is there? I don't know how this works. I don't think I've done it, but isn't there a deferment period? Like if you didn't want to make a payment for, so you're doing a $500 a month plan, and you are scared you're not going to make the $500, be able to make it in the next 3 months. How do you stop it? Or can you? You can drop it to a minimum payment. So whenever you set up a pension, let's just keep the 500 you're talking about. There's actually 3 buckets that are set up. So you have your target bucket, which is the 500. That's what we're trying to do for you. It's going to set up your retirement and everything. You have a minimum bucket if you're having a hard time, which is about half. So you could drop your payment to $250 if you needed to at any time. Or you can do a 4 times payment. So you could put up to $2,000 this month in there if you wanted to. So you have a big bucket for overfunding. You have your target, which you're trying to do, and you have your minimum. Now, let's say it gets really bad and you can't even make the minimum. The only time that's really going to hurt you, and you would have to go into like you're talking about, you can stop your policy for 6 months, but then 6 months from now, you can bring back up and you need to pay all your minimums. Okay, so that's like a worst case scenario if you had to do that. Typically what people do is, let's say this happened 2 years in and there's already cash value built up in your account. If you're having a really bad time, you would drop your payment to your minimum, and then you would tell them to please pull it out of my cash value. So basically you're taking loans to pay your premiums at minimum until you get back on your feet, and then you just pay your loan back off. So it kind of eats itself but it
Can.
keeps the death policy
Correct.
active and in place.
Correct. And it gives you the ability to next year fix it. You don't just lose it. You want to fix it as soon as everything goes good again. Because like you're saying, markets are up and down. If you're in a down time, it could get messed up just a little, but you don't want to lose it. And then when the markets are great again, it's easy just to take a lump sum and boom, fix it.
Are those, you were talking about earlier, rolling things in?
Mm-hmm.
So if you did a 401k or any of those things that you roll into it from your current employer or previous employer, there's no penalty as long as you roll it into this, something like this, right?
The FIA, you would not roll the 401k into the personal pension because remember, 401k is fully taxable. The pension is tax-free.
Gotcha.
If I was to roll the 401k over to put it into the pension, you're going to owe taxes and all that money is going to count as income this year. So if you had $1 million in your 401k, it would look like you made $1 million this year and you're going to owe about 40% in taxes.
Yeah.
You don't want to do that. So we would go to the FIA because then it's like to like, and it's a pure rollover. There's no, you're not touching the money. It's going from one account to another. So there's no tax issue at all.
All right. Anybody else have any questions? What do you call it? Beneficiaries, if you're not married, kids, don't have kids. Where, anybody have any questions about that kind of stuff?
Yeah, you can leave it to charity. You can leave it to your church. You can leave it to Daniel. You can leave it to whoever you want to. It's completely up to you. There's people that leave it to their pets. So, it's up to you how you want that money, where you want that money to go.
We just had a person that died and he left over $1 million. Somebody that we know left over $1 million to the VA. Yep.
Yeah. Charity. Yeah. And a lot of, and the company that we actually build most of our pensions with, they do a matching up to $30,000. So depending on what you're leaving, they will match, I believe it's 4% up to $30,000. So if you left the VA $1 million, they would get another $30,000 on top of that from the insurance company as a match.
Say that again.
So National Life Group, the company that you're with for your pension,
right.
They do matching on any portion of the death benefit that you give to a charity, up to $30,000 of a match. Yeah.
My son's we will give him a 501c. Could be a charity.
If it's a charity.
Anyway. All right. Well, nobody has any questions. What else do you have for us?
Well, what I do want to say too, is I know we're going to kind of wrap this up next week. And again, we really want to get some questions going so that we can really help you guys start thinking about certain things. What I would like you to do, if you didn't have time to watch the videos, check out at least 3 or 4 of the videos, but go to the Living Benefits tab and watch the Shannon Hay testimonial. It's 7 minutes long. Every business owner should watch that video. And you'll really get a feel for the type of policy that Daniel has that he's wanting you guys to learn about. The pension style policy, that's what they used. And you'll see what it did for that family through time.
It'll make you cry. If you guys didn't watch it. It's pretty phenomenal. Hey, and by the way, where his office is, we built those buildings in that video. I hadn't thought about that in a long time. But it's amazing, dude. You got to think about I don't know. We don't even think about, most people, we say we run businesses, right? But then we don't even think about we need our own pension. We need our own investments. And all we want to run around and do is invest in real estate. And we all know that goes up and down and down, down, down and up, up, up right now. But when he was talking about, the 8% or whatever, is that pretty much across the board? Because I don't think I've ever gone much over 8% in my account, but I haven't lost anything. That's the main thing. So it's a slow gain. It's not like these people, that hit $100,000 in the stock market, now they're losing over $100,000, but it's a very slow gain. But the main thing for me is that I can take this phone, and if I wanted to drop myself $80,000, I can do it on the app. And we go right into a savings account that we set up specific for this. You can set yours up however you want to, and then I can have the $80,000. I mean, it's really easy, but it's kind of like a set it or forget it. And mine, I think it took about 3 years before I could do that. As far as I could get 80 grand then, but maybe 10 grand or something. So
Yeah, and you can overfund. You can overfund up to 4 times your payment. So the nice thing with that is everything based on, so let's say when we're saying you can borrow 70 to 90%. So if your normal payment, let's say, is 10,000 a year, that means after that first year, when that 10,000 is in there, you can get $7,000 out. Let's say low end. Let's keep it very conservative. You could take 7,000 right back out. But if you can overfund, say, another 30,000 that year because you had a great closing, you can borrow 90% of the overfunding in 30 days. So it does turn, you can use overfunding to turn your pension into a bank very quickly. So if your payment into your regular pension is going to be, let's say, 1,000 a month or 2,000 a month, well, now you're looking at 2,000 a month would be, or let's just keep it 1,000. That's 12,000 a year, but you could put in up to 48,000. So if you had 1 or 2 good closings and you completely overfund this thing, literally in 30 days, you would have access to about $40,000 that you could pull right back out and go out and do something with. And that overfunding goes immediately to the cash side. There's no holding back on it.
So basically, if you have some slow months, this is the best safety net I've ever seen. And that's why I wanted to share this with you guys. And I also wanted to go into a little bit of CPA stuff, which, I mean, I don't know much about, but I wanted to talk about how you get paid, how this works on taxes, funding yourself. We have to pay ourselves first, or we will never have anything.
Mm-hmm. Yep. And another thing you guys need to be thinking about too is, right now, I'm guessing anyway, that most of you, it's just you. You're running your business, you're doing your thing and getting paid that way. It's just you, your LLC, whatever it is. If you do ever start working with a partner, if you ever have partnerships and stuff like that, you need to make sure that you sit down and you look at key man insurance. If you start having employees, definitely key man. Partnerships, you need buy-sell agreements. What happens if something were to happen to your partner? Because you got to think about it like this. You and your buddy might start a real estate investment company, and y'all are going out and doing stuff. But if your buddy passes away, you're not going to be in business with his wife. You're going to be in business with his wife's lawyer, or vice versa. If it's, let's say, Paige and Bonnie, you wouldn't be in business with the other husband. You'd be in business with the husband's lawyer. And so you got to keep stuff like that in mind. That's where buy-sell agreements come in, because if something happens to one of the partners, that policy pays out and it buys the other spouse out. And so
it's not if, man, it's when. Like, none of this is if it happens. And remember,
right. It happens all the time.
The only ship that never sails is the one called partnership. So be careful with the partnership. So
there's lots of things as you're growing. We're always here. We don't charge anything for advisory. Feel free, if your company's growing and your business is growing, if you need to just kind of bounce some ideas off, or just say, hey, can you relook at this? Can you do like a business preservation analysis for us? We'll come in and do that stuff. We'll look at your business, what you're doing, make sure that you have the things in place that are going to protect you and your family, as well as your partners and their family and all that kind of stuff. So we want to make sure everything's set up correctly. So retirement's just one piece of it. The living benefits, the protection, all the business stuff you can be doing, the banking features that you can be putting in place, the coaching on your write-offs and different things you're doing, making sure you're properly set up as an LLC with an S election, not just a regular LLC. All these different things you could be doing to help you, be more efficient in the business that you're running.
Next week, I do want us to talk a little bit about the LLCs, the difference between S Corp and C Corp. Just to let people kind of get a seed planted for it. And then maybe I'll have an attorney go into it a little deeper, how to get through that versus us talking about it. But I do want people to see to invest. I mean, you remember the what's it called, cash flow quadrant, you guys, last week that we put up and shared? It is so important to move yourself across that quadrant.
Yep, you want to be a B and an I. Everybody wants to be a business and an investor. That's where you're going to increase your cash flow by, avoiding taxes you're not supposed to be paying.
This whole thing is such a stress reliever. You know, we own a brokerage, right? So, you know, sometimes there was money coming in, sometimes there was always money going, right? So if we needed something or had to have it, and we tapped into this several times. That's why I know that's easy to do on the app, because when bills had to be paid, I didn't want to get behind on any of this stuff. And I just dump it back in there when things came in. So when people go around, they're worried about, oh, how am I going to feed my kid? How am I going to do this? How am I going to do that? This is the answer. And we have the ability to put a chunk in the beginning. And I don't know how many people have rental properties and things like that, but you can make a lot of money. You can lose a lot of money. You can have to replace a roof this month or not, you know, so you need to be invested in, I think, all of it. But this slow gain with the ceiling and the bottom matters.
Mm-hmm. Yeah, and that 8%, our pension plans have been averaging around 8.3% for the last 35 years. That means your money is doubling every 9 years. So that's a pretty good doubling effect right there. The FIA that I'm talking about right now with that 200% participation rate, its 12-year rolling average right now is around 11.85%. So, you know, getting double-digit returns on a product that absolutely cannot take a loss guaranteed, that is huge. And so, I mean, 8% on a guaranteed product is huge. Most of the time when you're talking to somebody about bonds and all these other things that you're not going to lose money, you're looking at 2, 3, 4%. Anything over 5 is great. We're averaging on our pensions 8.3 and on our FIAs over 11 now.
Good deal. All right, man. Anybody have any questions? We got started a little early, so I'll cut it off and stop the recording. I want you guys to hang out. I got a little housekeeping about the E-Trade app that came out for the Morgan Stanley for our stock benefits. I want to share with you guys. But anybody have any questions for Mr. Don Rice? Don, type your contact info into the chat thing again for them to get if they need it. I sent everybody out the website. I'm sure they can find you on there somewhere.
It entered too fast.
That's all right. And you can ask people what they want to do. And is there a minimum?
No.
So no questions for Don, huh? All right. He'll teach you how to hide your money. That's what he said. Don't let the IRS find out.
No. Now keep in mind, we do not teach you how to
hide your money. I heard it.
You will go to prison.
I heard it. Hide
you
the
have
money.
to avoid taxes you're not supposed to pay.
That's funny. All right.
All the contact information's in there. I will be in town Friday. I'll be in town all week next week. So if anybody wants to sit down and just have one of those financial advisory sessions, feel free to reach out. I'll be happy to set that up for you.
Okay. Thanks, guys. I'm going to stop the recording. Don, I'll talk to you later on, man, about next week. Thank you.
Thanks, everybody.